Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Mr. Daniel Yu, Global Strategist at Yuanta Securities. Mr. Yu, good afternoon. Thanks for coming on today.
Good afternoon.
Well, of course, extreme volatility in the markets right now. A lot of fear what the Fed's going to decide to do this week to get inflation under control and how that'll impact the economy. U.S. stocks officially now in a bear market, down 20% from the high in January. We're looking at 0.5% rate hike or more. What's happening in the global markets right now, and could we get some relief after this meeting?
Yes, if you look at the U.S. equity market, the sell-off actually accelerated in the last hour of trading day on Monday. As the investors were coming to some terms that the economy will suffer a major hit as the soaring inflation is forcing the Fed to raise interest rate much faster and much higher. If you look at the Dow Jones, it was down by 980 points. S&P shed about 4%. NASDAQ fell by 4.8%. Fed is about to be raising interest rate, probably the fastest speed that we haven't seen in the past. Now the probability of raising by not big step of 0.5%, but 0.75%, the chance of that has risen to 90.9% in the Fed meetings on the 15th of June, which is the Wednesday night in U.S. time and Thursday morning in Korea time. With this kind of expectation, we have seen a heavy sell-off of the major tech names, including Netflix, the Tesla, the Nvidia, and even for the some of the cyclical names, the Boeings. All these seems to be getting hurt. It seems that the selling pressure was happening not just on the tech stocks, but for the consumer goods related stocks as well as the energy stocks even yesterday. So it seems that everybody's quite panicking about the overall interest rate environment. Based on our analysis, about 0.5 percentage point rise of interest rate affects the S&P 500 by about 250 points. It shares that much, and depending on how high the rate goes up, it will cause the correction to continue. Right now, if you've seen the U.S. interest rate, the 10-year government bond rate hit as high as 3.44%, which is the record high level that we haven't seen in the last 11 years. If that rate continues to rise, then that obviously will affect the overall equity market even further and longer. But hopefully by the Fed meeting on June 15th, we'll get some signals that what kind of the interest rate track will be made by the Fed and how they will be controlling the inflation, whether or not they will probably just go ahead and then let the inflation runs as the inflation is affected by rather than the demand control, but the supply problems.
Well, Korean stocks down today too, but not nearly as much as some other markets. About 0.5% on both indices down, bringing the KOSPI down below 2,500 points, the lowest in over a year and a half. Some new 52-week lows for a lot of the big names. Tell us about the domestic market.
Yes, if you look at the KOSPI, it was down by 0.46%. KOSDAQ is down by 0.63%. Intraday, KOSPI went down as low as 1.88%. KOSDAQ went down as much as 2.94%. So it was quite a bit of a nice recovery. But people are concerned about this is not based on heavy volume, so therefore the recovery might be short-lived. If you look at the foreign investors, they are continuing to be net seller of the KOSPI by 273 billion, and also the futures market of 215 billion. So only the major buyer seems to be the institutional investors. Clearly, the currency is affecting quite negatively for KOSPI. If you look at Korean won, it weakened to as low or as high as 1290, so depreciating quite significantly. So it's very close to the 22-month low of 1292, which was May 12th. Of this year. So clearly, uncertainty about the currency and the foreign investors is affecting the overall equity market. However, as I said, the market did recover quite a bit. Main reason for that is because the futures market of U.S. have recovered. Now it's running plus 1.2% for the Nasdaq and about 1% for S&P 500 after heavy sell-off. So I guess people are hoping that Fed reserves, the direction will be given quite in next meeting. So after that, people can expect what kind of interest rate environment we'll be facing. Overall, however, though, we will see some of the weaknesses in terms of economic growth rate. Korea is still suffering from the trade deficit as the inflation and the pressure affects the import prices quite significantly, and that seems to be quite negative news for the time being. So therefore, we do think that the volatility might be continuing in the future.
Well, now, with those bigger rate hikes expected, as you mentioned, the yield on the 10-year Treasury has risen to almost 3.4%, up 24 basis points in the biggest move since March 2020. And the 2-year is only slightly lower and, in fact, briefly surpassed the 10-year on Monday. Tell us about that and what it's signaling about the markets and interest rates.
Yes, I think that the market going down obviously gets affected because of the possibility of economic recession. And economic recession gets affected quite significantly from what happens to the long end and short end of the interest rate. It seems that the 10-year government bond rate did go up, but the 2-year government bond rate going up was much faster, affecting that 10-2-year spread has turned to negative. Once that happens, usually about 20 months or so after, we will see economic recession. That is the average number. On top of that, if you look at the oil prices, Brent price is well above $120 per barrel. And based on some of the analysis that when it goes up to above $104, usually economic recession follows. So clearly the indication for the economic recession has risen quite significantly for the overall market. And that's the reason why the market is correcting quite significantly right now. If you look at the South Korea's 10-year government bond rate also hit the 8-year high. It is hitting at around 3.62%, slightly above the U.S. 10 years. Overall, it seems that the interest rate higher environment is definitely affecting negatively on the economic condition as well as the equity market. However, though, Fed will be giving some indications that how far they will raise interest rate in order to control the inflation. We think that the interest rate will not probably go up above 3.5% in a gradual terms. So therefore, we think that a lot of the negative news are already priced in, and so therefore, we think that Fed meeting on June 15 will be some kind of transitory or a change that we might be expecting for the equity market trend.
Got it. All right, Mr. Yu, we'll have to leave it there for today and see what the Fed does on Wednesday and catch up on that later in the week. Thanks so much for coming on today. We appreciate your insights.
Thank you very much.